Good afternoon, everyone. This is Rich Harper from Outdoor Industry Association. We'll be getting started in about 4 minutes. Good afternoon, everyone, and welcome to this Outdoor Industry Association webcast. Today's webcast is A New Threat to Outdoor Businesses, How the Border Adjustment Tax Could Dramatically Impact Your Tax Bill. My name is Rich Harper, and I'm the manager of the International Trade Program for OIA, based here in our nation's capital, Washington, D.C. Joining me today are two of our outside trade counsels, Ron Serini and John Kingery. We also have Rochelle Bernstein from the National Retail Federation, who provide some analysis on the impact on retail with the border adjustment tax. Before we begin, I just want to go over a couple of things. We encourage you to interact with us throughout the presentation by sending over questions through the chat feature. We will try to get to those at the end of the presentation and try to get to as many of your questions as possible. You'll also have the opportunity to follow up with me directly with additional questions. So feel free to type the questions as they come to you. We want this session to be collaborative. If we have the opportunity to address questions during the presentation, we'll try to do so. I think more likely we'll get to most of your questions at the end of the presentation. So without any further delay, why don't we get started? So again, I'll be managing the presentation today with John and Ron and Rochelle. So excited to have a good group of speakers that can provide a thorough overview of the border adjustment tax and some analysis of the possible impacts. But I want to begin by giving an overview of OIA's trade program. This is a tax issue we're discussing today, but it does intersect with a lot of our work on international trade. And so for those of you not familiar, I did want to give an overview of some of the issues, our trade program, some of the issues we work on. And one of the things I do enjoy about representing the outdoor industry here in Washington is that we do represent a diverse group of members. We have globally recognized brands and small family-owned businesses. We have members that utilize global value chains in the Asia-Pacific region, Latin America, and we also have Made in USA members. And ultimately, our goal is the same for both. I mean, we're working to ensure that federal trade policy fosters and promotes a stable, predictable environment for all outdoor businesses. And what we're trying to do is lower costs for businesses and outdoor enthusiasts, and particularly for our Made in USA members, help them identify new markets. Our guiding principle in our trade program is our balanced trade agenda. And again, we do represent importers and domestic manufacturers alike, and that does come into play here with the discussion on the border adjustment tax. And so very simply, our balanced trade agenda means we support the elimination of import tariffs on outdoor products where there is no viable domestic production. And for our Made in USA members, we support policies to help them manufacture in the U.S. and compete, transition to competition in a global economy. That does, as I mentioned, play into this discussion on the border adjustment tax, which came from the Republican proposal on tax reform, the Better Way for Tax Reform. Now, you may have missed it. It was released last June by the House Ways and Means Committee, the Committee of Jurisdiction on Tax Issues, released last June, and really to little fanfare. And I think the expectation at the time was, well, many times before we've tried to enact comprehensive tax reform, since the last time we saw such reform passed, and that was 30 years ago in the era of President Reagan and Tip O'Neill. The expectation, I think, really at the time was, well, the Senate may flip in November and Democrats may regain control of the Senate, and Secretary of State Clinton was likely to be our next president. So the possibility of the House Republican tax plan seeing any kind of traction was limited. And so the expectation was, well, this won't go anywhere. Well, of course, as many things did, this changed on November 8th. With the election of President Trump, Republicans maintained control of the Senate, and all of a sudden tax reform went from being an idea to a will pass. And so we strove to dust off our copy of the House Republican plan and begin to educate OIA members and solicit feedback, which is what we're trying to do here. At our last Outdoor Retailer Show in Salt Lake City in January, this is certainly one of the hot topics conversation among members, and really their questions prompted us to do more to educate the industry, and was the genesis of this webinar. First, I want to go over some key elements, and John will get into some of the specifics in his presentation, but just to go over some key elements of the House plan. And again, this is a blueprint, so we still don't have legislative details. That is still yet to come. We just have the blueprint that was issued last June to work off of. But some of the key elements of that presentation, of that plan, were reduction of the corporate tax rate from 35% to 20%, which certainly I think is attractive to many of our members, an immediate write-off of the entire cost of investments, the elimination of corporate alternative minimum tax, a tax credit for research and development, and finally the topic of this presentation, which is, I think, got the most attention, the border adjustment tax. Now, how will this border adjustment tax work. And again, a lot of the colleagues that I work with in our Trade Advisory Council and in the trade community have had to become tax experts in a short amount of time, and OIA is lucky enough to also have John and Ron from our outside trade councils to help us navigate through this plan. But I wanted to give a snapshot of how this might work, and I want to emphasize that these are very simple scenarios, just meant to give you an idea of how ultimately this will work. The specifics, you know, John will go into some more detail, but this is just one very simple example that you're unlikely to see in the real world, but just wanted to give you a snapshot of how this might work. So you have a backpack made in China and it sells in the US for $100. You assume the cost of that imported good is $95. And again, there are other costs that will go into that final price. So this is not a realistic scenario, but again, just trying to give you a snapshot. So your assume cost of imported good is $95, your profit is $5. You deduct the cost of the import and pay the 35% corporate tax rate on the $5 profit, a tax bill of $1.75. Here's how the border adjustment tax would work and affect that example. Again, the backpack is made in China, sold for $100, cost of the imported good is $95, profit is $5. First, as we mentioned, the corporate tax rate is reduced to 20%. The key point of the border adjustment tax is the importer can no longer deduct the cost of the imported good from the tax bill. So the 20% tax on $100 becomes $20, a quadruple your $5 profit. What is the effect of this new form of taxation? In many cases, costs may be passed on to the consumer, and this is significant for the outdoor industry. Performance apparel, performance footwear are unlike ready-made mass-market apparel and footwear, and so their costs to these products and a change in the tax plan with this border adjustment tax could significantly impact the prices that many consumers will face. How will this apply to our Made in USA members? Again, this is a key component of OIA's membership and a key component of our trade program. And the key point here is that exporters will be exempt from the border adjustment tax. And I'll get into some of the reasoning behind the border adjustment tax, but the key takeaway is if you're an exporter, you're exempt from this border adjustment tax. If you're a Made in USA member, domestic manufacturing, you sell in the USA, you'll still be able to deduct the cost of domestically produced inputs. For our Made in USA members that also use foreign inputs, the key point there is that you will lose the deduction for the cost of the imported inputs. And so again, for those imported inputs, you can no longer deduct those goods from your tax bill. So a significant change into how you pay your tax. Some of the reasons why we're seeing this border adjustment tax and why it's occupied such a key part of the House Republican plan. First, clearly they're interested in incentivizing domestic manufacturing and reshoring of American jobs. They want to create an incentive for U.S. companies to base in the U.S. and manufacture in the U.S. And they argue that our current corporate tax plan incentivizes companies to do the exact opposite and manufacture abroad to avoid a complex corporate tax structure here in the U.S. Proponents also argue that would offset something known as a value-added tax that other countries use, that they argue put the U.S. at a disadvantage. And John will get into some of the details of what is a value-added tax, but that's one of the key arguments that you hear from proponents is that it would offset the value-added tax that you see in other countries. The final point, and this is really a crucial point, not surprisingly, for a tax reform package, you need to find a way to pay for it. And the border adjustment tax will generate in excess of $1 trillion plus in revenue to fund the overall tax plan. So this is not a minor detail. It's central and key to funding the overall House Republican tax plan and will fund some of the other cuts that might be more attractive to some outdoor members. So it's a key revenue generator. What the impact of the border adjustment tax? And we've already talked about some of that. And so there are a lot of questions here. it's possible that your tax bill, if you're an importer, could go way up. And what is the impact going to be on our members, and particularly the small mom and pop shops that I mentioned earlier that are a key part of OIA's membership? Will it significantly increase their tax bills and impact their ability to stay in business? Will the tax bill, it could possibly go down for others. Again, we do have a number of members that are domestic manufacturers, and other members could take advantage of other parts of the tax reform plan and could see their tax bill go down. Will costs be passed on to the consumers? Again, you saw the example, the very simple example that we used, where a tax bill could be quadruple the profit, and the higher costs could be passed on to consumers. As I just mentioned, a part of the impetus behind this plan is to incentivize domestic manufacturing and incentivize exports. And we may see an increase in exports as a result of the implementation of this border adjustment tax plan. And then finally, the question comes about our obligations as a member of the World Trade Organization. And is the border adjustment tax would be in compliance with our obligations as a WTO member if we were to implement this border adjustment tax, an issue that John will go into in some more detail. But suffice to say, there have been concerns of whether or not this is WTO compliant, and if it is not, and if another WTO member brings a case against the U.S. and we lose, our exports could face retaliatory tariffs to offset the benefits of the border adjustment tax. And what have we heard from House Republicans since folks really started to pay attention to the border adjustment tax and the possible concerns about the impact on not just OIA members but other U.S. businesses? I mean, Speaker Paul Ryan and the Chairman of the House Ways and Means Committee, Kevin Brady, have been quite clear and haven't budged. The border adjustment tax will be a part of the House tax reform legislation, and they've made this clear in the face of criticism from some U.S. businesses in opposition to the border adjustment tax. But they've maintained their commitment that it will be in the final House bill. And what they've also argued is you have to keep in mind that proponents argue that with the border adjustment tax, you'll see a stronger dollar. And a stronger dollar will offset the losses of a higher tax bill, so make imports cheaper. So while you may see a change to your tax bill, a stronger dollar will offset those losses. And they emphasize repeatedly that the border adjustment tax, as proposed, is a trade-neutral measure. And so while you may see your tax bill increase as an importer, ultimately it will have a neutral effect overall on your business because of the stronger dollar and cheaper imports. They also insist that you look at all elements of the tax plan, and I got into this in a previous slide, that it may benefit some members. You may see your tax bill decrease, and if you take in all elements of that plan, not just the border adjustment tax, you may see that you stand to benefit from the overall plan. There's also the question of transition periods and exemptions. And again, we haven't yet seen the legislative text, but it's very likely that ultimately, if this were passed, there would be a transition period before the border adjustment tax comes into play and before importers would have to would no longer be able to deduct the cost of imported costs from their tax bill. And there also may be some exemptions. Some products may be excluded from the border adjustment plan. So again, border adjustment tax. We haven't yet seen the details, and in our initial conversations with the House Republicans, they've insisted to please take a look at the finer details when they are released, and keep in mind that it covers many points. And finally, they do insist that it will be WTO compliant. We haven't seen how they'll get there, but they do insist that whatever plan is released, that they are keeping in mind our obligations as a member of the WTO, and it will be WTO compliant. Of course, we have a bicameral legislature, and the Senate has not yet embraced the border adjustment tax. The Finance Committee Chairman, Orrin Hatch, senator from Utah, is working on his own tax plan centered on a corporate integration plan. And so it's not yet come out in favor of the board adjustment tax or indicated whether or not it will be in the plan that he will put together. In fact, one of his colleagues on the Senate Finance Committee, Senator Cornyn from Texas, who's also the majority whip, has called for hearings on the board adjustment tax, and he has argued that senators need to learn more, need to examine the issue in more detail, need to hear from proponents and opponents alike to get a better understanding of how the board adjustment tax may work and the impact it would have on importers and domestic manufacturers alike. And so he has cautioned that the hearings are necessary really before the House moves forward with tax reform, including the board adjustment tax. As though as indicated previously, Chairman Ryan and Speaker Ryan and Chairman Brady have insisted that it will be as part of the House tax reform plan. Now, where's the president on the board adjustment tax? And not surprisingly, it's a bit unclear. He initially, in some initial comments on the board adjustment tax, argued that it was too complicated. And then when we were looking at the discussion of how you might fund the proposed border wall, his spokesman indicated that a 20% tax on Mexican imports would help fund that wall. And in further discussions, it became clear that I was referring to the board adjustment, the House proposed board adjustment tax, which of course would not just cover Mexican imports, but would cover all imports. And then finally, there are reports from the White House have been that it's just the board adjustment tax is just one of many options on the table. So it is yet unclear where the White House is going to fall on this proposal. There are ongoing conversations between Mr. Brady and his committee and the administration on the proposal, but it's unclear yet where the White House will end up on this. And as with you may get the answer to where he ends up on the border adjustment tax, hopefully at a more decent hour than 3 in the morning. So what about the import tariffs that our members face? And this is a point I think we have emphasized in our initial conversations on the board adjustment tax. And again, OIA has not yet taken a public position on the board adjustment tax. We're soliciting feedback and input from our members, trying to analyze the key details and the bottom line. But one thing we do point out to, and we have pointed out to House Republican on the committee and leadership and other colleagues on the Senate side, is that while the proponents argue that the board adjustment tax is trade neutral, we do point out that while the average inbound tariff is less than 3%, tariff on outdoor products average about 14% and can go as high as 40%, and many of you already know this. But you already pay what we often call import taxes in the form of these tariffs, high tariffs and duties. And as many of you well know, these high import tariffs mean higher costs, means less innovation, and fewer jobs, and fewer Americans being able to utilize these great products in the outdoors. So some of the concerns that we've received from members so far have been that we pay these high import tariffs and we may, on top of that, face a higher tax bill due to the border adjustment tax. And so this is a concern that we want to bring to members in the House and the Senate and the administration, because again, as we discussed before, while this may be a tax issue, there are trade implications. And our members are concerned about the high import tariffs that they face, which is a key part of our trade program, and how the board adjustment tax could compound those high import tariffs. So what next? I think it's safe to say that this is going to be a key priority for OIA in 2017. We're working on a number of trade initiatives that I'm hoping we'll have another webinar to be able to go over and hopefully get you excited about. But this is going to be a key issue for us. And I think we heard that at the show in Salt Lake City. I've seen that in the response today to this webinar and the questions we've received from a number of members. So we're going to be on top of this for 2017 as the legislative process plays out. We're doing this in a number of different ways. First, engaging you all and soliciting your feedback. And I encourage you all to, if you're on the trade part of your team, if you're on the sourcing side of your team, to connect with your tax colleagues and try to at least give us a snapshot of how this could impact your tax bill. Again, understanding that we haven't seen the legislative text and we don't know some of the finer details. We begun last week to engage members of Congress and share our concerns and ask questions consistent with the way I think OIA approaches these issues. We want to put a good foot forward if we can. We want to take a deep breath, analyze all the details, ask good questions, and to determine where we might end up. So once the text is released, we'll do a deeper dive into the finer details and report back to the industry on what the exact details look like, and then we'll go about determining our next steps. So you all play a crucial role in that. I do want to provide enough time for questions, so that I did take some time to give a broad overview. I do want to turn over to my colleague John Kingery, who will begin the presentation on some of the finer details of the board adjustment tax.
Okay, thank you, Rich. Also, I'm joined on the phone by Ron Sterini, and here in the office by Dan Newman from Sterini Samet. So in the interest of time, let me just dive right in. So let's talk about a few of the terms that come up here. Of course, the first one is the border adjustment tax, border adjustability tax. There's various names that are tossed around for this. They tend to be used because they reflect a term from the WTO and its predecessor, the General Agreement on Tariffs of Trade, called a border tax adjustment, and that pertained to excise taxes and VATs. That's not really what's going on here, and don't get hung up on the name. At least as everything we've seen so far, nobody's paying an actual tax at the border, despite the name and despite what happens in VAT systems. These are alterations to the income tax system, so they get pulled in and washed through the annual corporate income tax calculation and payment. And now it's possible that somehow or other they put in some sort of withholding tax at the border. That we have not heard anything about that. They haven't said anything about that, but that would be not a tax in and of itself. It would be withholding the same way you get withholding from your paycheck on your personal income tax. So value-added taxes are a type of excise tax. That means that they are associated with a product. You are taxed on the product itself based on the value of the product. Unlike an income tax, which is not related specifically to any product, excise taxes relate to the products themselves and are therefore fairly transparent in what the tax is. A sales tax is an excise tax. Many things other than VATs can be excise taxes. There were a couple of old GATT cases where the U.S. was challenged on border taxes. There was one on a tobacco tax, imposing the excise taxes for tobacco at the border, and Superfund taxes on chemical imports. The U.S. lost both of those, but not because the taxes themselves were not subject to border adjustments, but because of the way they were administered. Now, cost of goods sold is a pretty normal thing to all business people, right? You get to deduct. If you buy 10 widgets, you get to deduct, to put into your product, you get to deduct the cost of those 10 widgets when you're calculating your overall income. Here, as Richard said, you don't get to deduct when you're doing your income tax calculation the cost of imported goods sold. Perversely, it turns it on its head, and it turns effectively the cost of goods, imported goods, into a profit. So cost becomes profit. And so, yes, we have joined hands with Alice and walked through the looking glass on this. This has been termed as a cash flow system by those proponents on the Hill, in contrast to the current system. We'll get into that in a minute. Really, cash flow system is just another way of describing a way of calculating income. I want to add one more term here before we go on that I should have put in here. This is also going to be a territorial tax system. That's only indirectly related to the border adjustment, but it's important for people to understand they are mimicking most of the other countries, intending to mimic most of the other countries in the world, and not tax profits derived from foreign operations. The purpose of this is to remove the incentive to park profits from those foreign operations offshore in low tax countries, and it also removes the incentive for inversions. That is, when you merge with another country overseas and thereby move your tax residence overseas. So this will be a territorial tax system. As Rich said, I'm going to skip some of these because some of this is redundant. This is a priority. It's a priority both for the Republicans in both chambers in different ways, and for the president, who, as Richard said, is uncertain as to whether to embrace the border tax adjustment. The idea here is to take the 35% current rate, which is considered uncompetitive, and make it competitive, though we have to recognize that the U.S. effective corporate tax rate is much lower than 35%, because we do have in this country and probably an abnormal number of deductions and adjustments that brings the effective rate down. And then, as I said, it's moving from the worldwide tax system with a potentially high tax rate to a territorial system, and that's, you know, an important aspect of the whole program. Just to give an idea, when they call it a cash flow, the major thing that is underpinning that is that they are eliminating the concept of depreciation. That's simply when you buy a capital good, be it a computer or a bulldozer, you depreciate it over its useful life. Now you're going to be able to expense that, and in the first year. So it will be very rapid expensing, and it reflects the fact that you've laid out the cash to do that. The corporate income tax gets cut, but this undercuts the idea of the cash flow system, of course, because you can deduct cash spent to buy a domestic input. You cannot deduct the cash spent to buy an imported input. Go back one, just yes, okay. So, and that's the important. I'll just re-emphasize that somewhat perversely, this means that when imported products are involved, the cost of the goods is no longer allowed as a normal deduction. It's taxed as if it were a profit. One of the claims is that the border tax adjustment, the BAT, is somehow equivalent to a value-added tax, a VAT. There seems to be a very poor understanding, not just among politicians, but a lot of non-tax people as well, as to how VAT systems work. And also there's not a realization that most of our trading partners, if not all, but certainly the big ones, all have corporate income taxes as well. So they are doing both. The U.S. is a relatively low tax country overall, partially because we don't have a VAT system. So these other countries may have lower nominal corporate tax rates, but they have similar effective corporate tax rates, plus they have VATs. Now, hang on a second. The reason the VAT system is it's trade neutral. And what we mean about that, if you look at it from the perspective, is there an incentive to sell domestically or an incentive to export? To look at it just on the export side, because people often complain in a VAT system you get your VAT rebated. But VAT systems, you know, operate in a strange way. You get a rebate of the previously paid, the VAT previously paid on your inputs, whether you sell it for export or domestically, and that's what's not understood. So if you buy an input, it has a VAT built into it of, say, 20%, which is not untypical in Europe. You then do whatever your manufacturing or distribution costs are, and when you sell it on, at that time, the government collects the 20% on that total value. But in order to keep from duplicating it, you get a rebate for the VAT you paid on your inputs. You get that same rebate whether you sell that for export or you sell it domestically. From the company's perspective, there's no incentive there, therefore, to export in that system, even though they see a refund being paid. The refund is neutral in both ways. And that operates the same when you're buying an import or a domestically produced good. Now, here's where I say I like to look at this from an incentive perspective as opposed to a government revenue perspective to understand how it's operating. Clearly here, in contrast to that system where I said, where you have no incentive on whether or not to buy an imported good or a domestic good, both are going to have the same VAT imposed on them at the time you purchase them, and when you sell on to the next stage of production, you get the same rebate whether it's imported or a domestic input. Here, it's completely different. Somebody's going to lose that deduction when they do their income tax returns for the cost of the imported good. So there clearly is an incentive to buy a domestic good. The way this is also set up, it also provides a clear export subsidy. So in addition to being territorial, if you export, you will not have, when you declare the transfer price at the border of your product, not necessarily being sold, you maybe have it transferred to another part of your company and you have to have an artificial transfer price derived, you will not be taxed on the profits from that. So there is an export subsidy built into this as well, but it's a much smaller one when you've worked through the numbers than the import penalty. So they're not imbalanced. If you assume a 20% tax rate, you would be talking about effectively a tax on imported goods. Effectively, it's not a tax, but it's the same economic effect of a 20% penalty on imported goods. And now, in the WTO system, you would say this dramatically impairs the value of WTO and NAFTA or any other FTA duty concessions because everybody's paying it. As it's structured, there doesn't seem to be any exemption for FTA partners. I suppose they could build that in, but it may actually be adding to the illegality by adding a type of MFN exception that shouldn't be there. So it obviously is treating imported goods differently from exported goods, from domestically produced goods. This is on its face a violation of Article 3 of the General Agreement on Tariffs and Trade, which is now wrapped into the WTO, and that requires national treatment. That means you have to give imported goods the same treatment as you give domestic goods. Now, amongst us lawyers and technical people, there's some arguments and discussions as to which subarticle of Article 3 is violated, but it doesn't really matter. I think it would also be a violation of Article 3 of the WTO Agreement on Subsidies and Countervailing Duties. Those are prohibited subsidies, and the cases, they're supposed to move faster, and the retaliation is supposed to be structured in a different way. That is, you're supposed to repay the prohibited subsidy when you've lost. So it takes a little bit of the prospectivity out of the system, and it would also violate national treatment of, for instance, of Article 301 of NAFTA. But there are so many ways you could describe this. It's also a prohibited export subsidy as well. So many different ways you could describe this. I recall Senator Lindsey Graham talking about a couple of the people he was competing with in the Republican primary last year that he didn't think too much of, and he said, well, you can vote for either of these guys, and it's a choice of whether you want to be shot or poisoned. And that's kind of the way the legal argument is, really. It just has very little chance, in my view, having been a WTO and a GATT lawyer for over 30 years, of being found WTO consistent. As Richard also had indicated, there are some economists saying that currency adjustments would neutralize the trade effects on imported goods. There's some people who have looked at this, and economists who disagree with that. Being a lawyer who's worked in this area, I would say that I've seen enough of the way these theoretical currency adjustments are projected to say it's empirically dubious. There are a lot of variables in currency adjustment, of which tax policy and import flows, export flows are only a portion. Capital flows swamp those, and they can be sometimes dependent variables in that sense that somebody can decide for political reasons to change the U.S. Treasury securities that they're buying, just as an example. But it's also not a valid legal defense. That would never be accepted in the WTO. And it's self-contradictory because it basically, they're saying, don't worry about it, at least from a trade flow perspective. The currency neutralizes the impact of imports, and so therefore it's all the same. So their justification for this is that it doesn't work, which is an odd justification. Also want to add there that what people keep forgetting is that if they were, let us assume that the economists are correct to say that the dollar will adjust this way, a 20 to 25% upward adjustment in the dollar, which is what they're predicting, would have a devastating impact on the export side of the U.S. economy. And again, as I said, there is an export subsidy built into this, which is also illegal, but it's much smaller. In effect, the way you calculate it, it comes out probably a magnitude smaller. It's hard to know because income taxes are, you're trying to impute income to, a specific product, which is not how it works. But it would be roughly, say, a 2% export subsidy compared to, say, a 20% import penalty. So they're not balanced, and the net effect of such a huge currency adjustment would be very bad on the export side. I think, Ron, you were going to pick up here, right?
Sure. So yeah, I think I'll be very brief given that, we want to leave some time for questions. So let's just make a couple points. I mean, as you can see from the slide, there are a large number of very important companies that are supporting this legislation, which means, that Congress is torn. So we're going to see how that plays out, but we expect those companies to continue to fight for movement of the plan through Congress. As Rich pointed out, we're seeing very little opposition from Republicans in the House, and that's primarily, in my judgment, because you have Speaker Ryan and Chairman Brady, who have basically gotten the word out that we should not oppose this, that we should let this go forward to the Senate, and once it gets to the Senate, that's when serious negotiations will begin. So I think we're clearly just at the beginning of the process, and I think for those of you who are alarmed, you have a very right to be alarmed, and Rachel explained the concerns from the retail sector, but we do expect the finished product that comes out of the Senate to be very different than what we're looking at right now in the House. So with that, I don't know, Dan, if you want to turn to the next slide, or Rachel, maybe perhaps you want to skip over to her side, then I can maybe summarize at the end.
Well, so I want to turn it over to Rochelle in just a minute, but this slide gives an overview of the legislative calendar for the upcoming year. And so it's possible that the House will take up the legislation before the 4th of July holiday, or certainly before August recess. And in the meantime, we'll also see, I think, hearings on the Senate side on the border adjustment tax. So we'll definitely keep you updated on the legislative progress of the initiative. And again, Brady has pushed back on some of the questions from the border adjustment tax, arguing that there be offset by other parts of the initiative and currency adjustments. And again, this is a key part of how the plan will be paid for. And finally, Orrin Hatch has argued that it's not yet a part of this plan, and has some concerns, and they'll likely, again, the Senate will likely hold additional hearings to examine some of these questions, particularly on the question of does it violate some of our trade obligations at the WTO and with our free trade agreements. So that's just a snapshot of some of the companies and trade associations support and opposition. I'm going to turn it over to Rochelle Bernstein from the National Retail Federation, who has come out against the border adjustment tax and has led the development of a coalition against the border adjustment tax. And so, Rochelle, over to you.
Thank you very much. So that's right. Obviously, the retail industry is very much opposed to the border adjustment tax. We are extremely reliant on imports for the products that are sold in our stores. We have launched a coalition that's called Keep America Affordable. .com is our website. The coalition is called Americans for Affordable Products, and obviously in my presentation I'm going to be talking about why we think that the impact of this tax really has to go straight forward to the consumer. We welcome all of you to go take a look at the website, and if you're interested in signing up for the coalition, there's a way to do that as well. As my colleagues on the call have already pointed out, there is, we're in the anti-border tax coalition. There is a pro-border tax coalition. So I think it's very important that we show members of Congress that we really have a much broader and deeper constituency that does not like this proposal. So, one of the things that that Chairman Brady has been saying with respect to retail is, oh, don't worry, they're really not going to be hurt. Whatever impact there is of this proposal is a transitional impact. And this gets to the issue that again has been discussed earlier on this call, and you saw an example of the numbers of how it works, that even though you're denied your deduction for your cost of goods sold, which is basically equivalent to a 20% tax on that profit, that magically, the dollar is going to get stronger, and in real dollars, it's going to cost you the same as it did before. So for what you used to pay $100 for, you can now pay $80, and you can still give $20 to Uncle Sam in taxes. The problem is, again, that, as others have said, that the economics, there is no empirical economic evidence that that's what would occur, especially with an economy the size of the U.S. economy, and also considering that there are so many bigger financial flows that impact currency adjustments. Also has been said, I was heard one international economist who said that literally trade, which is 1/360th of everything that would impact currency adjustments. So it's really such a minor part. It's very hard to believe it would happen. But even if it did happen, for a transitional period of several years, that impact would be real. And my first slide talks about the state of retail. This industry is not in a good position to sustain a sharp, hit to the industry for even a number of years. As many of you have probably experienced, the 2016 holiday season was not strong for traditional retail. We saw declines of 7% in department store sales, but really general merchandise, electronics and appliance and sporting goods stores also declined year over year. And following the holiday season, you saw tens of thousands of retail workers that were laid off in a wave of store closures. And so this is a time period when we need retail to be stronger, not weaker. If I could see the next slide. What the House Blueprint does is it moves our current income tax system more towards the consumption tax system. It's still not quite exactly a consumption tax, but I think that, again, the previous speaker spoke to why there are, in moving towards the consumption tax system, what it does is it provides incentives for savings and investment, which have the impact of dampening retail sales. And we've had a study done for the NRF that hasn't been published yet that shows that retail sales will be down for 7 years compared to where they otherwise would be if this law were not enacted. So obviously, considering where we are right now, we really can't afford a decline for a period of 7 years in sales, and that's before the border tax adjustment. But then if you look at a retail segment, it's easiest to look at one which is has 90 to 100% of their inventory imported, like would be the case with specialty apparel. Then in that case, we have gotten numbers back from our companies that prove the anecdotal example given to you earlier, and that is that companies would literally have a tax bill that could have a tax bill that is 3 to 5 times larger than their profits. Obviously, nobody can stay in business that long for even a couple of years while they're waiting for the currencies to adapt. We've looked at, probably at least a dozen analyst reports coming from Wall Street analysts that have that all look at retail as well. One particular analyst said that retail would be uninvestable if this were enacted. And if you look at what's happened in the stock market in the last week or two with retail, I think that, again, the analysts that are observing it say that a lot of the drop in retail investments is because owners and investors are thinking that that retail could be very hurt from this proposal. So that's just sort of, I guess, a pushback to what we think is a little bit too cavalier, and a comment back that we'll be able to survive for a few years as we wait for currencies to adjust and for growth from this proposal to come through. If I could see the next slide, please. So the effect on retail prices, and again, this is what was just talked about. So yes, if currencies completely adjust, there should be no impact on prices. But at least in the short term, we know that there will be. Most of the economists that have written on this say that there will be some time period before currencies adjust, and it is not clear whether they will completely adjust. During that time period, it's fair to say that for many imported products, there'll be a 15 to 20% increase in prices. Now, we know from our colleagues that we're working with in the refining industry that they predict that gas prices, for example, will go up by 35 cents a gallon. Well, we know from past experience, when gas prices go up, there is a large segment of our retailers that suffer losses because in the middle class there are a lot of people that have no real discretionary income, and when prices of essentials like gas and certain food products go up, then they have to substitute out whether they're buying new shoes or their outdoor equipment that they just can't afford. They will have to put off those purchases longer because they won't have that cash. And even though, again, the House proposal is estimated to cause the economy to grow and to have real wages grow, from what we've seen on how much wages may grow, they will not grow by 15 to 20%. So I think it's fair to say that among middle-class consumers who don't have that extra discretionary income, they will not be able to buy as much, and that means that our retailers will see a further decline in sales from what they otherwise would see. So, so in the last slide, please. So I guess there's my conclusion that we think that will cause retail prices to increase. Consumers will purchase less. Essentials will have a greater share of limited consumer dollars, and this will cause further instability for retailers that sell discretionary items that are already in a very transitional state in their business. And I'm happy to take questions.
Thanks very much, Rochelle and John and Ron, for excellent presentations. And we are working on assembling the questions that you all submitted so I can see them. I would note there on that last slide, if we aren't able to get to your question today, please do send it to me at rharper@outdoorindustry.org. And we will try to get to all of the questions that you all are sending in, because we do want to be responsive to what you have to say. So I apologize, I am working to, yeah, and turn over to John for one more comment.
Yeah, I wanted to add one extra thing here about the WTO legality, illegality. I mean, it is something, obviously, the United States has built this system since the end of World War II, and it has served us as a country well, and we shouldn't take lightly And I think a lot of people in the Hill don't take lightly the question of whether something is WTO legal or not. The European Union has been reported just in the last couple of days of already preparing a WTO case, and the authorized retaliation against U.S. trade would be huge. WTO cases take a few years to go through, and I've also heard chatter on the Hill about that. Not to worry, that'll take 3-4 years to work out, and then things will be different, currency will have adjusted, whatever. I just want to pose this as an open question, because we've also heard rumblings that on a trade measure of this magnitude, and this is a huge trade measure, that some of our trading partners may also engage in self-help, and may, remember, all of them also have corporate income taxes, and there's going to be a temptation once the impact of this starts hitting their export industries to start imposing mirror image legislation. We don't know if that's going to happen. It would be unfortunate if it's going to happen, but I don't think we can discount it. And that's an important aspect of this, is that it's not just going to impact the import trade. It has the potential for dramatically impacting the export trade as well, and challenging the structure of international rule of law that this country's been the major proponent of for 70 years.
So we do have a limited time left, so I want to try and get it to as many questions as possible, and if we don't get to yours, we will follow up. But first, will the slides be, we should be sharing the slides for this presentation? Yes, we will share the slides. We'll get them to those that registered for the presentation, and we'll see if we can also include them on OIA website. John, for you, does this apply to both S corporations and C corporations?
Yes,
I can
as far as
that, yes.
Yes, as far as losing the deductibility, yes.
When would you foresee this going into effect, and do you expect there to be a phase-in over several years? I think that's one of the key questions we'll have to see. I think legislation will be debated this year, definitely in the House. It's possible that there could be a transition period before ultimately this comes into effect. We've heard rumors of 5 years, it could be 7 years. We don't know. I think a version on this will be voted on the House this year. Whether it makes it through the Senate as well is unclear. And even if it does somehow pass, there would be a transition period.
Can I comment on that? This
Sure.
is Rochelle. The issue with the transition period, though, is this. So if they delay the impact, or if they phase it in, and you know, and economists do agree that there will be some currency adjustment. I think our fear is that it's not complete and it takes time. But the currency adjustment, supposedly, the way that it works is you won't see that happen until they actually put that piece of the border adjustment in. So if you did like a third up front and delayed the rest of it, then, you know, after some period of time, let's say 3 years, we'll see the dollar gets stronger. Maybe it gets to a full, you know, gets stronger for the full amount, but there will be a delay in each piece of the currency strengthening, so it will still cause that pain for some period of time in each of those phases.
So the next question is, how would this tax affect products purchased in China and shipped directly to customers in foreign countries such as Europe? It would not impact.
Them at all. No.
Right. Would not impact those products at all.
Remember, again, I said this is moving to a territorial system, so that transaction would be totally tax-free from a U.S. perspective. They're only going. The idea is that they're only going to tax economic activity within the physical borders of the United States.
Is there any thought of altering this to a system based on sales factor apportionment?
No. I don't think that's being discussed.
Yeah, that's not really what's going on here. They're not, you know, they're not trying to apportion where the economic activity took place. I mean, one thing we didn't go into as much here, but you know, there is this question of what if there are U.S. inputs into something that's re-imported. And I think the initial response, Ron, that you guys heard was that those would still be deductible. But as far as trying to apportion where income occurs there,
That's correct, John. I mean, there's a lot of unanswered questions that OI is working to get answers to, and we will, like also the question of can you deduct the duty you pay, which most people are saying yes, but we don't have a definitive answer. But we will be working on getting those answers with Rich and Alex and the OI team in the next couple of weeks.
And I think we have room for a couple more. Hopefully, what if you sell goods in the country where they're manufactured, say China? Would that be treated as an import or an export? Again, I think in this case, it would not apply.
It would not apply.
It would not apply. If imported products are exported, again, would the BAT allow COG, I assume that's cost of good, to be considered as an expense rather than profit and hence taxed at 20%?
If it's re-exported, was that question?
Yeah,
question? It's unclear. I mean, they haven't said anything like this, like that. You would, I think the answer is that you would not end up paying that the tax on that if it were re-exported.
The way that it works is, you know, you're basically filing like a corporate income tax return, if you will. And you're going to get a section that you're not going to be able to deduct the cost for. That's what comes in. On the other hand, the income from what you earn on your export sale, okay, will not be included in your tax. So so I lose the deduction for my cost of goods sold that come in. I do some other things here. I end up with a profit on my export, and that profit is not subject to the 20% tax in the U.S. That works more of like an income tax. Unlike the import is taxed more on the whole value, that's more like a sales or excise tax. On the piece going out, it's going to be the income that you earned, I believe.
Yes, that's right. You would, if this is what the question there is an open question in the sense that if you export a product that's made in the U.S., you of course get all the deductions for those cost of goods sold. The question here is, if instead of, you know, what if you have imported inputs into that cost of the U.S. manufacturing that's then re-exported, and it's possible that they would allow a deduction for that since it's re-exported again. It's just one of these holes that we don't know because this is a 31-page blueprint that they gave us.
And I apologize, we have one more question left that we'll follow up with the questioner on to respond to. But I did want to thank everyone today for joining us for the Border Adjustment Tax webinar. Access to OI webcast is an important member benefit. If you're not currently a member, please visit outdoorindustry.org to learn more. We're also very interested in having you join us for our annual Capital Summit in Washington, D.C., April 25th and 26th, an opportunity to engage with members of Congress and the administration on issues critical to the outdoor industry, and following this past election, that's more critical than ever. So again, please contact me, rharper@outdoorindustry.org, with any other additional questions. Please don't hesitate to reach out. You can also follow me on Twitter @RichOIATrade for the latest and greatest updates on the Outdoor Industry Association's trade program and issues like the border adjustment tax. Thank you again for joining us this afternoon. Thanks, Ron, John, and Rochelle, and we look forward to continuing to work with you on this issue.
Thank you.